Welcome. This is the September market video update from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO. The title for this month's webinar is A September to Remember, alluding to some of the historical movements that we see as we start to approach the fall, which we're going to talk about, right, Bob?
Well, there's that, and there's so much going on.
There is. So let me first share my screen here. There's a lot going on, and we are going to, as per our cadence in the past, we're going to talk about the markets, the economy and policy, and everything else. However, as you and I were talking about with Kyle in preparation for this presentation, there's always things we have to decide not to talk about, and so we thought we would address that as well.
Yeah, so this is a list of, yes, we're not talking about them, but don't think we're not thinking about them.
Mhm.
They just didn't really make the list. So there's always a list of maybe 30 to 50 things that we can talk about that we don't talk about because we're already long-winded to begin with. But you could read this chart, whether it be the stable coins or gold or bonds. There might be a small, beautiful bill on the horizon, a micro bill. There could be the debt crisis in the UK. There's the Russia-Ukraine conflict continues. There's the new Three Amigos. It's not Martin Short and Chevy Chase and Steve Martin. It's India, China, and Russia. Canada seems to be a mess right now. How about Taylor Swift, who got engaged?
I was just going to say we should act like a media,
How are we
put
not
it the
talking about that?
priority.
Yeah, or the Taylor Swift tax, which is like a tax on secondary residences in certain states that need money. Labubus, how could we not talk about Labubus? And for those of you who don't know what that is, good for you. It's
Yeah.
a waste of your time and money.
Yeah.
There's redistricting, there's the Fed independence, and maybe some firings or not that's going on. Government shutdown that could be on the horizon.
Yeah.
There's this that micro bill that might pop up is challenging some of the tax-free treatment of certain municipal bonds. So there's so much that we can talk about on top of PCE and CPI and PMI and PPI and JOLTS, GDP, GLP-1, AAA, triple B, M&A, the ABCs, the one, two, threes. So if you
We're
really
trying to
want
turn
us
it
to talk,
into a song. We're not there
yeah,
yet.
if you really want us to talk about a topic, please let us know. There's always so much to talk about. Hopefully, what we're about to talk about is really what you need to know, at least through our lens, and what really matters most. So we might as well just get right into that.
Yeah. The only other thing I would say is we do appreciate the feedback that we receive, and we want to continue to receive that. If you can see from this slide, we get a lot of feedback, and so we
Mhm.
do have to prioritize. And a lot of times, some of these topics may come up in future webinars.
Mhm.
All right, so let's jump into it and let's talk about the markets so far this year. We're going to dissect it a couple of different ways.
Yeah, so far this year, so interesting chart. Charles Schwab puts this out every once in a while. So it really just shows the major equity markets, which are the S&P 500, the Nasdaq, the Russell 2000, which is small caps, and the Dow. Year-to-date return on the S&P, which we're going to call the market, is about 10%, maybe a little bit less right now. This is about a week old. The Nasdaq is right around 12, probably right around 10 as well. Small caps are positive up 6, and the Dow's up 7. Return since the low, so they have it as April 8th, which if you're a client of ours and you've been listening, it wasn't the 8th, it was the 7th. But on a closing basis, it was the 8th. But we'll go with it anyways. So yeah, the S&P from the bottom is up 30, and then all the other indices, you can read that for yourself. But the drawdown, the where it was and where it went from a high to low standpoint,
Correct.
yeah, the S&P was down almost 20. Again, 20 on a closing basis means the bull market's over. We didn't get there. Bull
Mhm.
market's alive and well. But the Nasdaq and small cap, the reason why we don't use them as good barometers for any of this stuff is they're, wild and crazy. They went down more.
Yeah.
So they enter their own little bear markets, but not the S&P, the market. The average member drawdown, so the average company, the stock within the index, usually is always worse, right? And that was true again this go round. So the average stock, let's say in the Nasdaq, because it's flashy, went down 47%. right? Peak to trough. Now it's not that
Correct.
way now, but
Correct.
that's where they went. And then below that, this is more of a who's participating in all of this fun. The percent of the S&P members, so the percent of the companies outperforming the S&P 500 glued together, it's rarely above 50%. Very rare. It's usually around, a third of the companies do all the work.
Hmm.
And what we've seen over the past month is, an above average amount of participation. About 46% of the companies in the S&P have outperformed the S&P.
Right.
But if you go to the 3 month basis, it's 29%, 6 month, it's 30, 1 year, it's 22. So over the past 1 year, only 22% of the actual companies within the S&P have outperformed the S&P, which hint hint is why we only buy a tiny micro slice of the S&P, and we think it is always the right slice that we invest in, and we can prove it to you maybe some other time.
No. Yeah, and looking at the Magnificent Seven, which have been the drivers really of the S&P for the last few years.
Yeah, so depending on your exposure to these companies, some of you will have exposure to these companies outright. Some of you have had exposure to these companies for a long period of time. And, who are we kidding? Apple is probably the most widely held security in the world, and they're negative so far this year. You can see that on the second to bottom line. That is let's call that a marine blue. How about that? The
Yeah.
marine blue line, second from the bottom above the purple line. Purple is Tesla. That's the worst performer of the Mag 7. They're down, what is it, about 20%. Apple's still down about maybe 7% on the year. I think that will change. But if you're a heavy investor in those two securities, well, your return has to do with the allocation of your portfolio.
Yeah.
And if you have a heavy dose of those two, you're not as happy as having a heavy dose of the two on top, which are Nvidia and who's up there, Meta.
Yeah.
So this is just a good view of, yeah, they're all doing different things this go around, at least
Right.
temporarily.
At least temporarily. And if we dive a little bit deeper under the hood of the Magnificent Seven and maybe look at Nvidia, which from their recent earnings report has created a lot of attention.
Yeah, the only reason why we put this on here, so we never take a deep dive into one company's
Yeah.
earnings. And again, this is not a recommendation to buy or sell a security at all. Let me get that compliance statement out there. Meanwhile, it's in the fine print of all of the presentations that we do. Hopefully, you're mindful of that. Anywho, uh, NVIDIA reported this incredible earnings call last week. And what stuck out to me was this. They said, hey, none of that money that we created over the past quarter came from China. Nothing? Nothing. So this was a quarter
Right.
where they blew through their expectations. And, initially the market sold it off.
Hmm. Yeah.
Why? Well, it's like, well, I wanted more. Like, yes, you knocked my socks off, but I wanted you to, you know,
How dare you not do more?
really blow me away.
Yeah.
And wow, these analysts want so much. They
Hmm.
demand so much. But then the conference call started, and the CEO, Jensen Huang of NVIDIA, said, oh, by the way, yeah, we didn't sell anything to China. Well, what do you mean? Is that like, are you exaggerating? What, just like a few things? No, zero. No chips sold to China in Q2. So they did all this
Hmm.
without any help from, really historically a decent contributor to their revenue
Right.
and earnings.
So the question
So
then is, what is that potential revenue?
yeah, and it could be billions of dollars. So that's a good sign, I would say. So, and I'll leave it at that. But they were able to do this quite easily without any participation from China, which is a significant contributor to their earnings over time. So
Well,
more to come on that.
more to come. My husband was one of the ones that asked about this, so he'll be thrilled that you answered, Bob. So
Mhm.
now,
All-time highs.
all-time highs, right?
And
We are,
according to you, Julina, and I'm
huh?
just going to have to believe you here,
I know.
according to you on this one, you say we live in all-time highs 80% of the time.
We live in all-time highs 80% of the time. And this is not my statistic. This is coming from Michael Semblus from JP Morgan, who has a lot more respect in the industry, I guess, than I do. So let's go with it.
And you know what? Because it came from him, I'm not even going to question it.
There you go.
But it makes a lot of sense, right? Why? Well, because chart out the market over a long period of time. And what is the direction?
Hmm.
Up,
Yeah.
right? 80% of the time it's up. And you can get that visual if you run any chart of the S&P 500 over a long period of time on a total return basis. It just kind of goes up.
Mhm,
And that is where we live, and we'll continue to live there. We're in a bull market. We've had 19 market days
mhm.
where the close of the market on that day, we were able to ring the bell and say it's a new all-time high. And I actually believe, how about this one? Going to go out on a limb here, Julina. I think there might be at least 19 more to go.
Mm.
How about that?
We're going to mark that and we will circle back and see how we
And
do.
and Julina, the way we are, if we're wrong, we're going to take this video and edit it months from now. So you didn't hear me say it. I'm just kidding. We can't do that. Uh,
But I think your point about September, and this is the reason we titled it September to Remember, right? This is not a
yeah.
Michael Semblis comment. This is a Julina comment. The market doesn't go in a straight line. It's a yo-yo on an escalator. So the yo-yo historically goes down in September.
Wait a second. It's time to be negative now. What did I miss? All right. So September, a September to remember. Obviously, that title is driven by there's so much going on. The crosshairs of back to school, the crosshairs of Wall Street is back to work, the crosshairs of, hey, the Fed might cut now. What did they change their mind at the Jackson Hole meeting 2 weeks ago? The crosshairs of, are we, what's the tariff thing? What's going on here? Will we have a micro bill? What's going on with India? When did they join the two angry amigos to make it three? Is the Fed independence at risk? And then you have September, which for many reasons, one of the primary reasons being it is the fiscal year end for many businesses, asset managers, nonprofits, endowments, pensions, and there's rebalancing that goes on, a lot of selling of the good and buying of the not so good that happens in this month. That makes it the worst month of the year almost all the time,
Yes. And,
right?
and this data goes all the way back to 1950. It's
Yeah.
the worst month back to 1950. It is the worst month for the past 10 years. It's the worst month for the last 20 years. And post-election, it is one of the worst months.
Yeah. So don't throw tomatoes at us. September is just choppy.
Yep.
And it's good because you get all that choppiness out usually in September. And then second half of October, you start to see some better stuff as the fog of September kind of goes away. November is usually very good.
Yeah.
December is usually very good. So, let's get through. I know everyone thinks October because of like the Black Monday in October, but actually October is usually pretty good. November is really good. December is usually quite good.
Quite good. Yeah.
So we're in for a great fourth quarter. We just got to get through September.
I think a couple points. One is it's healthy for the markets to take these breathers. And number two, this doesn't necessarily mean we're doing anything with the portfolios because we're not talking about anything fundamental. So let's give some reasons for optimism in terms of the markets going forward.
Yeah.
And we'll start with earnings, which is where we normally start.
Yeah. And the prices move in the direction of earnings. So the markets, their prices move in the direction of earnings. Well, earnings are up often. Here is the thing that backs up we're at all-time highs 80% of the time because earnings keep reaching new all-time highs 80% of the time. And you can see that looks like it will just continue, that chart. You have now large cap in red, that red line, small and mid cap, the blue and green are also, I mean, you got to zoom in, but they're also, sprouting in a positive way. So we might have a more full participation, deeper breadth and depth market, which is really a good scenario. And we're starting to see that over the past couple of weeks. We think there'll be more of that to come.
Yeah, I think even going from the first quarter of this year into the second quarter of this year, to your point, the participation doubled in terms of positive earnings. The Magnificent Seven, when you look at the red line, was double the earnings of the S&P. And then I think the other thing we will point out, we don't have it on this slide, but when you look at earnings in Europe, because there has been a lot of attention on international this year, Europe earnings were zero,
Yeah, zero.
zero. And we'll
How about
probably
that?
talk about that in a future webinar.
We definitely will.
Okay.
Yep.
Another reason for optimism that we've talked about in the past is this abundance of cash with corporations.
Yeah, lots of cash, and that cash, in bank accounts at these companies is coming from the demand for corporate bonds of
Hmm.
these companies. Well, where is the demand coming from? Pensions and endowments. They need more yield.
Yes.
And, to a degree, they're begging companies to issue more debt in exchange for cash, so they can get a slightly higher yield than treasuries, right? And the companies are like, well, all right, if we can borrow money, in essence, where the Fed borrows money or a little above, sure, we'll we'll take your cash. And
Hmm.
now when you have cash on your balance sheet, well, what are you going to do? Well, we can build buildings, we can spend it on R&D, we can create new products, we can hire more people, we can be more productive, we can pay out greater dividends, we can buy back our own shares. When you have this level of cash, certainly in the hands of corporations, they can help support their own stock price. So they are part of the demand for their own shares. How about that?
Right.
Right? Which in a way reduces the outstanding shares, which makes anyone who owns their shares more valuable, right? There's scarcity value. There's
Hmm.
fewer of them available. So when Apple is buying back stock, they're doing it for a few reasons. Number one, because they should. And if you're an investor in Apple and then you're looking at all the cash that's not invested, it's like, hey, go do something. One. And if you don't do that, that's where activist investors come in and they challenge you about it. One. Two, um, much of the compensation paid at these companies nowadays is in shares of the company, right? They dilute, they print a ton of shares, and they just give you the shares as part of your bonus or long-term incentive plan, and in some cases just standard compensation. But you got to have shares in your hand to give them away. And then the other is to help support the stock price, and it's a good use of their capital to buy back their own company,
Yes.
right? It's a great sign of I believe in my company. I will use the corporate cash to buy back some of the company, which is a really a good thing to do. So this is very positive. When you don't see this happening, um, you know, there's a different scenario that comes along with it. But we are seeing this continue to rise and break new records, and I don't see anything getting in the way of this anytime soon.
Absolutely. Yeah.
Yeah.
I think another great point for optimism, and if I had to make sure I have the right slide here, if I had to pick my favorite slide for this month, it would be this one because, again, everyone's questioning where do the markets go from here as we're approaching these all-time highs. That's when the anxiety kind of kicks in. However, we're going to talk about this. If the Fed, after they cut rates last year, 50 basis points in September, and then 25 again in November and December, then we've paused. Now the question is, if they continue to cut, what should we expect from the markets?
Yeah.
And if you look on the left-hand side of this slide, we are looking at historical periods going back to the 90s. We're looking at six different environments where they paused, and we're taking that average return. And if you go to the right, we're looking at different asset classes in both stocks and bonds.
Yep. Yeah. So it's the resuming rate cuts
Hmm.
creates higher asset values, period.
Correct.
Now, that varies depending on how sensitive the asset is to a change in rates. And what you generally see is growth stocks, which are here, I'll put everyone to sleep, which are long duration stocks. They tend to be the most sensitive to a change in interest rates. Whereas multi sector bonds, certainly diversified, they're sensitive, but they're not as sensitive as large growth stocks. So there's a few things. So rate cuts, so lower rates. Number one, if you're a consumer, great way to look at it is you can afford more, you can finance more. Things could become cheaper, even if you don't want more. You get to refinance maybe your house using the outstanding balance that you have, and then recasting your mortgage now at a lower interest rate will actually save you money.
Hmm.
There's a chance that you take that savings and you go to Home Depot to buy some storage bins so you can swap out your summer clothes for your winter clothes. At least that's what we do here in the Northeast, right? If you're in Florida, you have no idea what I'm talking about anymore. But ultimately, lower rates provides stimulus to what? Consumers sometimes, to risk asset prices, to the value of a business that has a cash flow that needs to be discounted back using an interest rate that's lower that creates more value.
Yeah.
That's how it works, very simply.
Yes.
And I know that wasn't simple. I'm just being cute. Now it's funny. That sounds like a sort of a twisted economy and market slide. Well, it is. We kept it in markets because now the lead in is to cover more of this rate cutting that it sounds like we heard a
Yeah.
couple weeks ago.
Yep. And really quickly before we get into the economy and policy following this, I just want to point out for clients that are listening, in our portfolios, the largest piece of the bond piece is the multi-sector bond category.
Mhm.
And so we've liked the diversification of that piece. However, if you look at this, if you can get equity-like return in the bond space with cutting rates that and doing it with lower risk, that is a risk reward that we like to see in portfolios.
Mhm.
Just wanted to throw that in there. So thank you.
Have at it.
So let's pivot now to the economy and policy and talk
Oh,
about the
well
Jackson
done.
Hole pivot.
I see what you did there.
I know, I just wanted to make sure I got that in.
Hey, way to pivot.
Yes.
And the Jackson Hole pivot, yeah. Jerome Powell came out with a speech a couple weeks ago at Jackson Hole, the vacation meeting for the Fed, where they don't take questions. They just have a long-winded statement because they're on vacation. They don't want to answer any questions. And that statement was as if everything they have said this year at every other meeting did not happen. Exactly like we predicted in January, what they said was our concern is shifting away from inflation and towards the labor market weakness. There's risks of slowing job growth that now weigh more heavily on in policy discussions. What? It's like, okay, you finally told the truth. Yeah, when it gets close to action time, they start telling the truth. When they don't want to do something and don't want to be pushed, they will give you some narrative and start to change the numbers in a way where it's like, are you out of your mind? You question if they even know what they're talking about. They do. They're just using smoke and mirrors to get everyone to step away. Don't put pressure on us. And then there's usually a meeting where they tell the truth. And this was filled with truth serum, this meeting.
Mhm.
The stuff that he was saying, I was mouth open watching this statement live. And I'm like, wow, finally they're addressing what's actually really going on. They're more concerned with unemployment, and unemployment is going to force them to cut interest rates. There's a few things. You have less job growth. Number one, the government, the biggest hirer of them all over the past 4 years, is not hiring. Number two, the government laid off a lot of people or offered packages in January that will now be effective in September and October. So that data has to negatively roll into the system, and it's
Mhm.
coming.
Yeah.
And companies are no longer overpaying to, get you away from your current employer over to them. They have found enough people, right?
Mhm.
And some of them are even starting to lay off a few people here and there. So it's a very different labor environment. Now we're still at or near full employment. And even with more unemployment, we will be at or near full employment.
Right.
But it's not as rosy as it was a little while ago.
Yeah.
Another component of inflation is wage growth,
Mhm.
right? So one would say if now the advantage is back to the employers, there's not going to be nearly as much crazy wage growth as there was over the past 5 years.
No.
Had to overpay to just get people to come to work and underperform. So there's the winds of something different have finally blown in, at least in the minds of the Fed, finally. So they said all sorts of different stuff that was so bizarrely on the other end of the spectrum versus what they've been saying just at this one meeting last month that, oh boy, the market is already pricing in that rate cut. And we'll go to the next slide to show you that.
We'll go to the next slide to kind of quickly first look at the June meeting and see how that actually shifted.
Yeah, so in a weird way, we took the language of the Fed from this most recent meeting a couple weeks ago or a week ago, whenever it was, and we tied it to their summary of economic projections. So long story short, it's just interesting. Every calendar quarter, they come out with their short and long-term expectations
Mhm.
for economic growth, unemployment, inflation, and their interest rates and what they'll do. And they've been tinkering with this thing in a way where it was creating a lot of confusion. And we pulled out statements from their big statement at Jackson Hole and tied it directly to what we think will be big changes to this SEP, Summary of Economic Projections, that's going to come out on September 17th, along with a decision likely to cut rates.
Hmm.
And they're going to move these numbers in a way where they said, hey, we put these numbers in writing and now we're above or below them. And this is why we're cutting rates. Yeah,
Hmm.
because you're the Fed and that's what you do. And you could say, well, this was our target. It's now below or above. And we're going to make the changes. So be ready for this. We think there's going to be some pretty significant changes. And, the talking heads on CNBC or whatever channel you're watching will be talking about the changes to the SEP. Well, here it is. We're forecasting it ahead of time.
Yeah.
There are going to be some changes, and it's going to be driven by a lot of these comments that they made.
Yes. And to kind of see maybe more the visual of that expected change, right? This is the probability of them cutting rates.
Yeah. So in prior videos, I had mentioned, hey, look, this Fed might just be second half of the year focused. Why? Well, last year, they were talking about rate cuts, but then they stalled. And then at Jackson Hole, they pivoted with some language. And then in September, they cut rates. And actually, last September, they cut rates twice in one meeting. So that's two 25 basis point cuts, which was a 50 basis point cut in one meeting. And then for the rest of the year, they cut it an additional two times.
Mhm.
And I said, hey, maybe this Fed is very um, neat and organized and regimented in a way where they just want to do it maybe second half of the year. Well, what do you know? Last year, the probabilities before the September meeting were almost identical to now this year.
Yeah.
86% versus 89.7%. So we're looking at a cut here in September, and it's very likely we will get a cut, at least another cut before the end of the year, very likely three total. I wouldn't even be surprised if they do four, like they did last year, between
Hmm.
September and December this year. So more to come, but they're cutting.
They're cutting.
Yeah. Now,
And
if
I
there were
think
Q&A, if there were Q&A available at this meeting at Jackson Hole, they would bait him into confirming it. So that's why they don't do the Q&A.
exactly. Yes, because it's not an official meeting.
Correct.
So, given the fact that the Fed is so focused on labor, right? Let's switch over and look at jobs real quick in the revisions.
As they should be. Yes. And less on inflation, as they should be. Yeah. So here is, we think the benchmark revision will happen this month. And there will be a revision to less employment. And it might be a significant revision that factors in maybe the government layoffs on top of truing up some of the data from the past all in one. So, there could be a very significant revision in a negative way. I would be shocked if there's a positive revision. And I believe the Fed is aware of this. And I believe that is why they finally rang the bell and decided to, morph their tone away from inflation and into employment and unemployment.
Okay. Yeah.
Does that make sense?
Yeah, it does.
Yeah, like this data is sort of as they say, in the can already, and they are aware of this data. They do have direct insight into this data, and I think that was one of the main ingredients that they used to help formulate the new talking points.
Yep. Okay. Thank you.
Yep.
And I think just sticking with jobs, one more point. There's an interesting slide here that we found on labor force participation by demographic.
Oh, it's interesting. All right. And I'll get to why. But yes, this is labor force participation rate. Interesting how they measure for people 55 years and above and under 55. But you see, there's a lot more participation from the youngsters out there than there are for senior citizens. Julina, wait a second. We can
Who
get
put
an
in senior
AARP
citizens?
card soon.
Kyle?
I mean, not us, right? We are on the doorstep. We got to change the definition of senior citizen and push it
Well,
to,
one of
you
us
know,
earlier than the other, but
yeah,
yeah.
well,
Yeah.
listen, we're getting there. To, I don't know, 100 plus.
Yeah.
So if you're under 100, you are youthful, chipper. Say it ain't so. We're getting there, Julina. This is sad. All right, next slide. Let's get over
Okay.
this.
Yeah. Moving on. Let's go
Uh,
back to tariffs because
hey, tariffs. What's going on with tariffs? Do we still charge them? Are we issuing refund checks yet?
there's a
Anyway,
lot of revenue coming from it, right? It's tripled.
while we were collecting tariffs, taxes. We collect a lot of money.
Yeah.
Next slide.
Yep. However,
But do we have to issue refunds? Well, I hope you kept your receipt because there might be refunds, at least for some of it. So what they did here is, one of the small courts, the lower courts challenged it and pushed it to the Supreme Court. Supreme Court's going to rule on it. And who knows? They may say it's unconstitutional because technically this should have run through Congress, which it didn't. But I do think if they throw it back to Congress, I think it's just the Senate that has to rule on it. I don't know enough about that, so don't hold me to that statement.
mhm.
But I do think that is the case. If it does fall back to Congress, which I think is just the Senate, I would expect don't laugh at me for saying this, everybody, but I would expect it to be more streamlined. Insert the laugh track now. But I think it will, because this is kind of wild. This is like, you know, this for you and that for you and this for you and that for you and this because you gave me a bad look and this because I don't like the way you dress every day and you like Italian food and you don't. There's no rhyme or reason to it. It's personal in essence. I think there may be some streamlining. I don't think the tariffs will go away. I think if it falls back to the Senate and they get their hands on it, it is there probably will be more structure to it. I'm thinking, but we'll see. And then the refunds, good luck getting a refund, even though you might be owed one. We don't know. So this is part of the September to remember because there's just a lot going on.
Maybe to take the tariff conversation one step further, you can take a look here as to where the revenue has been coming from and from what.
Yeah. So the payers of tariff revenue or import value, where it's coming from, China
As
uh,
intended.
is, yeah, as intended, the big one. Shockingly, Canada is, small. Such a high rate for Canada and Mexico, but such a small amount of tariff revenue.
Yeah.
What does this tell you? It tells you we still rely on China for a lot. And then you look on the right side, the types of things: consumer goods, industrial intermediaries, capital goods, raw materials, and other. So, um, again, if you've been buying Chinese goods and you've been paying those tariffs, hold on to your receipts.
Yeah. Yeah.
We'll see what's going to happen. Nobody knows yet. So,
Okay. Yeah. And I guess one last economic point in this section that we wanted to address was housing. And we have a couple slides here as it appears to be cooling off.
yeah, housing, the big weight in the inflation calculation. Depending on the calculation you use, it could be a third. If you use another one, it could be almost half. But housing is cooling off. So great job on this slide. This is a chart of housing from Zillow, Case-Shiller, Freddie Mac, uh, Cotality Home, ICE Home Price Index, PCE Housing, and you can just see all these
All of them.
indices are lower, way lower
Mhm.
than the PCE indicator that is stale. And that's the thing that's used in our inflation calculation. Like everything is just about half of that rate
Right.
and trending even lower, mind you.
Yeah.
For good reason. Next slide.
Yes.
There are more sellers than buyers out there. Yeah.
Buyer's
Well,
market.
why? The buyers don't want to sit on the sidelines. They just can't afford the prices that are being asked. Number one, when you add finance cost to the price,
Mhm.
right? So if we had a 5% mortgage environment instead of a 7% mortgage environment, yeah, I think the sellers and buyers would be at par with one another.
Yeah.
But I think that the finance cost is just forcing people to wait it out, especially when you have a Fed that is gonna, you know,
The market
assist on the
stance.
short end.
Yeah.
Yeah, at least the ARMs adjustable rate products will come down.
Mhm.
30-year fix might not move much. So that needs some greasing of the wheels there to happen, and we'll get into that in a minute. But home prices are coming down, and many of you may not know that the housing calculation for inflation, according to the government data, is actually rent focused. It's owner equivalent rent.
Yeah.
So, they'll call you, Julina, and ask you about your house. Say,
Mhm.
well, what do you want to know? Well, we want to know if you rent it, what do you think you'll get? And you're like, well, but I live here. They're like,
Right.
just play the game with us.
Yeah.
Well, you're like, well, wait a second. Logically,
Never
I
done the
think,
due diligence.
yeah, I've never been asked to do this. But I think ultimately, if you're telling me what I would rent it for, I would logically think about, are there a ton of homes in my town for sale? And is there a big demand to get into my town? I would say, yeah, okay. So I would want to rent it for a ton of money, right? But then if things change and there are tons of listings in your town or your state, that will sway your opinion the next
Mhm.
time they call and ask you this, which is exactly how they do it
Right.
for the PCE CPI calculation. They ask you about what your house would rent for. And I think logic would say, you would say, well, every home on my street is for sale and they're not selling, so I don't think I could rent it for as much as the last time we spoke. So I think it will be less.
Yeah.
And they will doop, 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 put that into the data pool, and then out comes a much lower housing inflation read.
Yes.
And I think that anchor that is housing is going to more than offset a lot of the other potentially inflationary items that have much lower weights in a way where inflation won't rise
Hmm.
much,
Okay.
if at all.
Right.
That makes sense?
It does.
Coming soon.
Yeah.
Coming soon. And that has been our theory all along
We
for
have
the
discussed
past
this
for
before.
the past 2 years.
We've
And we're
criticized it before,
oh
so
yeah.
yeah.
Oh, we're still
Um,
doing it.
yeah. So Bob, you want to talk about a possible housing emergency?
Yeah, okay. Make fun of me because this is so off the beaten path. Anywho, when you hear the president, any president, talking about bringing the 10-year treasury down, I mean, that's so uniquely specific. That's so off the beaten path. It's like, why is the president talking about bacon bits? You know what I mean? It's just, wow, who really says something like, well, the 10-year treasury should be lower? I mean, that's okay, why? Well, there's a method to that madness. It's because longer term interest rates are tied to all the lending products that are out there.
Hmm.
Things like auto loans and mortgages,
Yeah.
right? If the Fed cut rates by 4% or 400 basis points, and we were back in the less than 1% environment, the 30-year mortgage rate isn't going to change much because those live in the space of where the 10-year-ish treasury is, right?
Hmm.
And that is more economic driven and debt and deficit driven, GDP growth driven, national policy driven, unless you manipulate it, like the Fed has and Treasury has over the past 20 years. How did they do that? Well, TARP and quantitative easing.
Huey.
They bought their bonds back from banks when banks were in trouble. They targeted bringing down the yield curve by buying a whole bunch of the bonds that they issued,
At massive levels.
right?
Yes, this was not a small project.
Yeah, that's why the United States government is the biggest owner of its own debt
Yes.
because we bought that stuff back at some point from someone,
Yeah.
usually an entity, to either provide liquidity in return or to target the yield curve to
Hmm.
provide stimulus.
Correct. So we've done
I
it
think they're going to do
before.
it. I think they're going to do it again.
Yeah.
How they do it might be different this go round, but I bet you they try to target something that brings car loans and mortgages down. Thank God, because the average person needs help there because rates are way too high for those products.
Yeah.
And those are the big economic drivers. You know, if you go buy, I don't know, Fruit Loops, if anyone buys Fruit Loops anymore, I don't. But if anyone still buys Fruit Loops, it doesn't move the needle in our economy. Um, or mouthwash, right? It really doesn't move the needle. But if you're buying homes, that moves the economy. It's a big ticket item that has to be financed. The financing is usually paid to a bank, right? You can see how that circular motion moves through the economy, and the
Hmm.
bank has earnings and so on and so forth. So I really think it's number one, people need assistance there, affordability of high price items that are financed for a long period of time. How do you do that? Well, you bring the finance cost down. If you can't bring the price of the item down, bring the finance cost down. Great. How they do it, question mark. Probably a very targeted buying mortgage-backed securities, or doing something like, if you make under a certain amount of money and you buy a home under a certain amount, uh, forget about the 30-year fixed rate that you see quoted on TV or online. You get a special rate.
Yes.
And I hope they do that,
Mhm.
because the average person in this country cannot afford the finance charge of most big ticket items nowadays. So more to come on that. But we put it out there because we think we'll see something soon around that. Now, I would tell you, you will hear a heck of a lot more about this if the Fed doesn't address it and or bring short rates down enough. Enough for who? I mean, that's subjective.
Correct.
I think you can fill in the blanks there. If they do, then this may not be a reality. It may take care of itself,
Right.
but we'll see.
I I just want to point out that this is something that's been on your radar all year, and it was on your list. It's on that list. And
Yeah,
so,
we're only mentioning it because Scott Besson
yeah,
hinted at it, and our ears perked up. So he said, we may declare a national housing emergency in the fall.
right.
What? And then he changed topics.
Yes,
I'm telling you, they are putting something together.
we'll see. And one last point on the economy and policy. Let's talk about prices at the pump.
So we just talked about housing being a huge piece of inflation.
Hmm.
Well, the other huge piece, which is not obvious, is energy. If you buy anything from Amazon, it has to be delivered to you, whether it's drone using a battery, or van using a battery, or tractor trailer using diesel or gasoline, or a plane that uses jet fuel. The cost of energy is an outright category,
Yeah.
and it is indirectly within just about every other category. That makes sense,
Yes.
right? So, well, the price of oil has come down, the price of gasoline has come down. So, if you take the weight of housing plus the weight directly and indirectly of energy, that is going to drive inflation one way or another. And in this case, it's down. So, I think any offsets that are rising will be met with declining housing numbers and declining energy numbers.
Gosh,
So, even this is a little stale. When I drive around,
it's what, a week
uh,
old?
yeah, when I drive around here in my town, I've actually seen prices in the mid twos.
Yeah,
I can't believe it. Um, yeah, so the price of energy is way down, which, is some relief. So pretty
absolutely.
significant relief too.
Yeah. And we'll transition now to just a couple points in the everything else piece and start with this evolution of ETFs.
Yeah, so an ETF is an exchange traded fund. What does that mean? Well, it's a mutual fund, basket of securities, that is traded live during the day, every second of the day, just like a stock. Whereas traditional mutual funds are traded once a day at the end of the day. So you can't enter a mutual fund during the day or exit it during the day. That's where exchange traded funds come in. You can enter and exit live. That makes sense? And
And
they're priced live.
they're priced live, and the ETFs are the reason that we were able to buy at the lows for our clients intraday on April 7th.
Mhm. Yeah,
Yep.
we wanted to buy a basket of securities live, that was liquid enough to handle the amount of money that we were going to put into it, and we did.
Yep.
Right. Whereas if we
Absolutely.
bought, I'm just making this up, the Vanguard S&P 500 mutual fund, that would have been bought at the end of the
At
day
the end
at
of the
a
day.
very different price level, mind you.
Absolutely.
Anyways, there are now more exchange traded products, funds that own stocks or bonds or both, than there are listed companies in the US market.
Amazing.
So leave it to branding and marketing and consumerism to lead to product expansion. I believe there's 4,400 US listed exchange traded funds. There's probably 4,000 too many exchange traded products, right? But everyone will tell you how special theirs is compared to the other one. But anyways,
Yeah.
so there's an abundance of options and confusion in marketing that's going to go on to capture your dollars, of course.
Mhm.
Thankfully, you have us to do the due diligence and to call out the nonsense that is most of them. But we're saying this for a reason because, over the years, if you've been investing money for a long period of time, you probably remember a day where good companies would go up and bad companies would go down, right? There was no meme stock,
Right.
no like, hey, the kids are buying this stock. And usually, they're bad companies. That didn't exist. You were either a good company or a bad company. And professional investors, on top of individual investors, would always look for good companies to invest in and maybe try to time it and buy a bad company at a time where they were going to try to turn things around or they were on the verge of discovering some new thing, so on and so forth. That was investing, 20, 30, 40, 50 years ago. That's
Yeah.
how it worked. Now, because there are so many products that own everything that you can invest in, you have markets that rise and fall together.
Right.
The good stuff goes up with the bad stuff and goes down with the bad stuff, and vice versa. It all moves in the same direction
Yeah.
all the time, right? So you either have a bad day or a good day. There's no in between anymore.
Right.
Why? Because your money is being stuffed into terrible products where no one has done the due diligence and it's just invested in everything.
Hmm.
Why expel energy or thought or skill if you just own anything and it kind of works out?
Hmm.
We are not believers of that, just so you know. Today, the rise of passive investing, just own everything and pray that it works out, continues to rise.
Yeah.
And look, there's some exposure that we have to things like dividend growth. Yeah, we like to buy baskets of dividend growers. Historically, that works out very well. There's a quality filter there. Sometimes we will buy passive indices like market cap, maybe large cap versus small cap, value versus growth, sectors, buy the technology sector. That's passive. You just buy the
Hmm.
market cap weighted technology. But we don't like to buy everything
Correct.
ever,
Yeah.
ever. Because I don't care what environment we're in, there's bad stuff that you want to avoid, both on the bond side, on the stock side, and everything in between.
Yeah.
But the rise in passive investing, which is just invest your money in everything, continues to rise. And there are just better ways to do it if you have skill and energy and thought. Um, uh, it's if you have a fiduciary duty, why would we purposely invest in terrible companies when we can avoid them?
Yeah, and I would also say, you and I have been around long enough that we have seen the evolution of this ETF world where when they were originally created, it was active versus passive, which was
Mhm.
mutual funds versus ETFs.
Yep.
And at the time, I lived in the mutual fund world and I watched the evolution of these mutual fund companies saying we should create ETFs.
Mhm.
And I'm saying this because today, when you look at an ETF, it doesn't always necessarily mean it's passive. It can be active.
Right.
And so I think this is important because our clients that own ETFs need to know that when we choose an ETF, there is a process around that ETF that we believe in.
Yeah.
It's not just buying a basket of securities. There's a philosophy and there's a reason we're putting it in the portfolio.
Yeah. Winging it doesn't exist here.
No,
And it
and
won't.
and kudos to Kyle and all of the research that our team does in-house to understand every ETF that is out there and understanding should we or should we not utilize that for clients. So I'll
That's right.
stop there.
Yeah. So again, when you're thinking to yourself, wow, everything goes up and down together. Yeah, it's investors have been positioned in a way, whether they're doing it themselves or being forced by their, you know, professionals to just get invested and you got to own everything, even the bad stuff, because that's what my firm is telling me to tell you, because we don't want to spend time thinking anymore. We are not believers in that stuff,
Yeah.
thankfully.
Yeah.
Anyways, this
I
helps
just wanted
define.
I wanted to state that because I knew it would egg you on into your.
Yeah, don't get me started with this topic. We better change slides really quick.
Yeah, so we'll end now on a good note, which is it's back to school season, and a lot of us have kids, grandkids, nieces, nephews, entering the schools again. And I thought this was an interesting visual.
Yeah, back to school. So, many of you have seen text like this before, but we learn 10% of what we read, 20% of what we hear, 30% of what we see, 50% of what we see and hear, 70% of what we discuss, 80% of what we experience, and 95% of what we teach. So thank you, teachers. We need you now more than ever to think clearly and to treat the children with loving care, discipline, um, fill them with great education and help us with values and all that stuff. Feels like we're leaning on teachers more and more nowadays, and hopefully teachers know that they are needed more and more nowadays. So we are incredibly thankful for our teachers because without you, not sure how we would learn. I don't care what the people say. AI will not be able to teach our kids because that requires self-learning, and you need to teach first so people can learn. And who does that best? Well, hopefully everybody chips in, but certainly the teachers are at the forefront of that. So we appreciate you. We thank you. And we need you.
Yes. I couldn't agree more. And I would also say that the philosophy of the teaching is at the core of our firm as well. And so thank you, Bob, for leading the charge on constantly educating all of us in the industry. And we will continue to do so in the best way we can, and proceed on with the month of October and see what's to come. So
You got it. It's a September to remember. Just you wait.
I just want to end with, I wanted to call it September stinks, but yes, it's a September to remember. So,
My title is way better this go around.
yeah.
Yeah.
So, but we thank everyone for your time. And as always, if you have questions, feedback, we welcome it. Just reach out to any of us here at Principal Wealth.
See you in a month.